Good morning, and we'll get underway with the webinar now. Just to run through, you should be able to see the screen. I think everybody's got a copy of the screen up there now, and we'll walk through today's presentation. Just the host today is myself, Patrick Reid. I'm a Director of Aged Care, Community and Disability at StewartBrown. Sitting with me today is also David Sinclair, who's a partner at StewartBrown, and also two very experienced long-term accountant and consultant within aged care. David's been with StewartBrown for over 20 years, so good to have David here. He'll be looking at your questions, so if you do have any questions, you'll see on your panel to the right-hand side, you're able to submit questions to us throughout the webinar. We'll do our best to deal with those in line. If we can't, then we will share them with the group after the webinar as well. So just to be aware of that as we move through. If you do have a question, please do submit it on the system so we can record it and then reply to you afterwards. So what do we know about aged care? I mean, really, the current status of the system is it is a time of significant change, and we know that there are challenges ahead. In fact, the Department of Health released their discussion paper on integrating CHSP and the home care program today, even though that has been pushed down to 2020. Look, and really it is a time when innovators will look to prosper, and I think we can say that technology is certainly a disruptor and is emerging and will hopefully assist us in the transition process as we move through the reforms. We need to invest in those technologies, but also to our staff, processes, infrastructure, etc. And of course, the big change we've seen over the last 3 to 4 years has been that growing movement towards consumer choice and ensuring that consumers are receiving the services that they need and want. So in terms of the future directions of aged care, when we're looking forward, you know, we do know that within the market itself, the acuity and frailty of our clients, and including other issues such as dementia, is rising wherever you are providing services, whether it be in residential, home, or even retirement, independent living, and so on. And the rates of dementia, etc., in the community are growing. We also know that throughout time the costs are increasing across all services, and unfortunately our funding is not increasing at the same rate or a matching rate. We'll talk about that a little bit later in the seminar. And technology, of course, as we mentioned earlier, is a primary differentiator and really will enable clients to have a lot more knowledge and choice as they move forward, but also too, as providers yourselves, they should provide you with control, reach, access and management capabilities that you currently do not have within the market to make sure that you are able to use those technologies to benefit yourself. I think one of the biggest challenges, and we know that the government's provided about 1.9 million in funding for workforce and to look at the issues of workforce, is that it will become a defining issue for the industry around quality, performance, the scope of services you provide and the delivery of those services. I think as we're looking at care moving forward, you know, the care will be the constant and you know, the delivery will be the differentiator in that respect. So workforce will be key for us moving forward. And of course, consumer choice, really the type of care they wish to receive, the accommodation styles that we provide, and the levels of service that they want to see are all going to change as we move forward. And we're already seeing some impacts of those now within aged care, and particularly post February 27. So it is a time of challenge, but also I think when we look at it and talk to providers around the countryside, it is a time of opportunity for providers. Very important that we look at it in that frame. And although there's more competition from new entrants, and we'll talk about the numbers that we've seen through this time, there's also opportunity to expand and look at other services. If we look at the total number of people receiving aged care services, you know, it's about 1.2 million. You know, that's only really 10% of the total population of people over 65. So there is a wider pool of people that you can draw on if your service is targeted towards them. We're also seeing more competition in home care, and we'll show you some of the figures around that, and not necessarily from traditional players that we have, you know, incumbents in the market. So something we need to be mindful of as we move forward. I think the other thing we're seeing is consolidation of providers, and really, you know, meaningful consolidation is what we're looking for, and we're seeing some really interesting, you know, players come together in the market as we move forward. The other one, of course, is if you're not going to merge or consolidate, is it formation of partnerships and alliances. And again, I think carefully constructed and thoughtfully put together partnerships can be far greater than the sum of their parts, and we do see a lot of interesting partnerships and alliances forming at the moment, and that will continue. And again, in many cases, aged care is operated in what we would call silos, where different parts of the business necessarily weren't, needed to be managed as an integrated unit, but more and more with the continuum of care from home all the way through to, residential care and then end of life, is that we will need to see better integration between those business units as we move forward, and even some new business units that may emerge from that timeline. So moving forward into the survey itself and the reason why we're here, important to understand where the survey comes from. And we do have 869 residential facilities in the residential part of the survey. Not all of those end up, or that data ends up in the survey. About 831 facilities provide data, because we do excise quite strongly any outliers or information that may skew the data set. So important that we do know that's a very solid number. And that number of beds of data is about 66,000 beds that we pull data in for through any of those survey periods. We have 479 home care programs within the survey, and that provides us with almost 20,000 home care packages which we can draw data from. So quite a significant data set to be taking these trends and insights from. If we roll all of that up, it provides us with more than 24 million days of care data. So again, just trying to size that information you're going to see today to make sure that you can see that it is significant for you to look at. So why would we use benchmarking? We know about 13% of 15% of you from our poll at the start don't use benchmarking. Really, it is to determine and understand sector trends. We can see broad trends and also two niche trends from the data. Important to see which way the sector's moving, and particularly with consumer care, how that is defining the market itself. It also drives improvements in financial and operational performance, because you can set and maintain goals, know exactly how your operations are performing against their peers, and we do make sure that you're able to rank yourself against providers in a similar cohort. So important to know what those in a similar scenario, similar environment are performing. You can also measure and compare your operations against other organisations of similar size, as I said, or look at like markets. So interesting to be able to again benchmark yourself against those areas. It will allow you to assess productivity, and I think we know within health sometimes productivity can be a little bit fraught as a concept, but it is important as we move forward that we are looking at how our productivity is measured when delivering services, and particularly as we move to a more outcomes-based approach for the provision of care with consumers. And then really the ultimate goal of benchmarking and any of this information, the reports that we do, the special deep dives and research papers, is to allow you to set goals and make informed decisions. Particularly if you have a board, or if you're a board member on this webinar, and also too an executive, important that you do have solid information upon which to make your decisions, but also too to set the goals for your staff to make sure you are reaching those outcomes. So just to give a little bit of background about the bands, and we'll talk about this when we get to home care as well. Really, we do size the bands. There's 5 bands within the residential care, predicated upon a per bed day revenue or turnover size. So you can see the 5 bands there. Band 5 is under $190 per bed day, up to over $235 per bed day for band 1. So as you see, we'll talk about bands all the way through, just so you understand how they're derived for the survey. So what do we know when we're looking at the aged services sector? Really, we do know that our length of stay is shortening. We do have somewhat of a 2-speed market in residential care, particularly those clients who come in for 3 to 9 months, really end-of-life care, high acuity, high needs, clients who are really less than 1 year, and other clients, particularly dementia clients, who may be there for 2 to 3 years, so that 2-speed market. We know that occupancy remains high. We'll talk about occupancy in a little bit more detail later. But we do need more beds on the ground, and at the moment we're building about 3,300 beds per year, and that won't get us to the 76,000 beds in 10 years that the government has predicted that we require. When we look at home care, we do know that new providers are entering the market. Unfortunately, the margins are declining in that market. It's a price-led market at the moment, but that was occurring before consumer-directed care and choice came in, so it's something that we do watch quite carefully. And really, aged care as a general statement, it's not just home care, but aged care in its entirety is moving to a more retail base where the consumer is driving that market and certainly defining the products that they wish to see. Seniors housing, and really social housing is now seniors housing. in any way, shape or form. A lot of debate around retirement villages, of course, with some of the discussions around AVO and so on. But we know that it's not 55 years and over anymore in terms of lifestyle. You know, the average age of entry is greater than 77 years, but the average age across the board is 84 years. So that cohort's ageing in place within retirement villages. But it is also to a large cohort, so 184,000 or more residents within retirement villages at the moment. And the CHSP, as we said, it's been kicked down the road until 2020, which is placing some pressure on package levels 1 and 2 in home care, and we'll see that through the data as we move forward. And of course, as I said, the department has released their discussion paper on the integration of CHSP with home care today, if you wish to have a look at that on the department's website. So just to look at the global funding and the sizing of each of those segments, the Commonwealth Home Support Program has about 1,600 providers and provides services to almost 1 million Australians. So it is a very large program, obviously capitated budgets, you know, which is not, you know, you don't have to reconcile that. It's an acquittals-based program. Then we look at home care, almost 500 providers in that particular segment, and addresses about 80,000 odd clients, and we know that there's some packages released in March. We'll discuss that later on. And then residential care, almost 1,000 providers and delivering services to almost 200,000 Australians. So if you roll all of those up, about 1.2 million people within Australia are receiving some form of aged service today. And as I said, that really equates to you know, a smaller proportion of the people over 65 than you would expect. So there is some scope there for services, you know, if they are bundled correctly, to go outside of just the Aged Care Act themselves. But if you look at that funding, 2.1 billion for Commonwealth Home Support, home care at 1.5 billion, and then residential care at 11.4 billion, you can see why there is a focus on home care in terms of cost containment, because it is relatively cheaper, given the numbers of people, to deliver those services in the home as opposed to elsewhere. And then if we roll all of that up into the total number of providers, we can see that there's about 2,000 providers across the continuum, and many of those do operate in more than one segment. So you have aged care providers in 1 or 2, home care and residential, or home care CHSP, but about 130 providers also across the whole grouping, and that is growing. So in terms of the mix, you know, there is quite a bit of cross-pollination between those segments, and that will continue. And of course, we do know of providers and some of our clients who also provide, you know, NDIS services, childcare and other services, you know, accommodation, affordable accommodation, etc., in the market as well. So quite a broad scope for many providers in Australia. So we'll move into the residential results and move forward into that information. As I said, there's a lot to get through. I will be going through it quite quickly. As I said, you do have opportunity to ask questions. So please, if you do have any questions or chat, let us know. And David is being my moderator on those questions, and we'll try and answer them as we move forward. So I'm just going to look at the highlights, and then we'll dive into some deeper, you know, more granular information as we go. So this is really the headline information that we're looking at. So just to give you a view of how we determine care results, which is really just the care revenue minus the care expenses. And direct care costs include the hotel services, utilities, administration, and support service costs. As you can see, they're outlined there. And really, what we're trying to do with these is to get you down to a facility level result, you know, to make sure that you do have the information available there. And as I said, the March 27 data set for this area does incorporate 831 facilities and 66,000 beds for that total. So looking at our operating results for the sector and for residential care, we saw an average care result of $9.93, which is a decrease on the year from March 2016 of about 50 cents per bed day. And really, when you look at that, it's unsurprising given the changes to ACFI during the first half of last year, 2016 year, all the way through to 1 January of this year. We expected that to ease with ACFI changes, and of course, we're now seeing the effect of that. But if you look at the top quartile, which is the red item below, their average care result of $38.29 is far above that of the average, and we'll have a chat about that in terms of how they achieve those results. But it does come back really when you look at it to cost management, and we'll go through a little bit of that in detail later on. Looking at the average facility EBITDA, that came in at $8,616 for the year, and was a decrease from June of about $325 per annum. And again, for the top 25%, there's about $10,000 difference in those two results of $18,526. So quite, a marked difference between the top quartile, the top 25% of providers, and the remainder of the market around their results for the quarter to March 17. In the first half or first quarter of this year, from sort of January through to March, a number of providers were telling us that they were seeing a softening in occupancy, and we did see that a little bit through the results in March. The average occupancy dropped about 0.5% thereabouts to come in at 94.6%, but generally you could say that occupancy is still quite strong. And again, talking to providers towards the June end of financial year, many were saying that occupancy had shored back up again. Look, we can point to that because we know that the department released about 14,000 home care packages in March 2017, and really, there was a lot of advertising moving into that release. We knew that February 27 was coming. Some of that advertising around people being able to be maintained in the home and other issues around the release of packages may have led to that softening of occupancy. But we'll have a look at some of our RAD pricing, etc., later on, and talk a little bit more about occupancy in relation to those figures. So looking at the overall result, we've got about 70% of the market is delivering a positive result. That is down from June 2016, which is around 75%. Probably more concerning for the sector is that 117 facilities had a negative EBITDA. And we'll look at a side-by-side analysis of providers later on. But that is up markedly from June 2016. About 40% more providers are showing a negative EBITDA for the March quarter, so quite concerning for the sector overall. And for that bottom 75%, their care result of $1.27 per bed day does indicate that times are relatively tough for the market. So again, trying to feed the family and send the kids to school on $1.27 per bed day is relatively difficult. So then looking at the bottom 50 and 25% of the market, a loss of $7.44 per bed day on a care result, and then $18.67 for the bottom 27 result, which really, when you're looking at an overall sector, difficult to be sustainable losing $18 per bed day on a care result, and really that does also indicate a lot of cross-subsidy, more than likely from larger providers to those facilities. So looking at that cross-subsidy, and that's something we will investigate in our June survey to try and look at some correlations between that cross-subsidy moving forward. And then looking at some of the accommodation and incoming funding around the average deposit for RADs and RACs. The average deposit held was $273,000 into that March 17, so that's historical and does predate the financial year, what you've held previously. As we said, the clients have been in there for some time, but the average deposit taken in the 12 months to March 2017 was $312,000, and that is a 9% increase on that year to March 17. So showing some relatively good increases in terms of the RADs taken in that timeline. As we said, the top 50 average care result was $27.13. And then looking at the care result across states and territories, you know that size and location do affect the results of providers. It's not a cookie cutter in the market. The highest result was New South Wales with a care result of $14.96 on average. And the lowest result was a $1.44 loss in the ACT, and there are some reasons around that, but we'll investigate that a little bit further. So as I said, moving into some more granular results, we'll move into that now. And looking, as I said, the impact of cost management on those results is quite marked, and we have the figures for the top quartile in the first column, the bottom quartile average in 17, and then the 16 results for each. There's, as you can see in the facility care revenue, there's not a lot of difference between the facility revenue at 221 and 220 for the average. So only about $1 odd difference there. But the real difference is in the care expenses. We can see that the top quartile had care expenses of $183 and the bottom quartile had 218. So quite a marked difference there between the revenue and expenses line for those two areas. And the difference there is $38.29 as opposed to $1.27. So you can see that cost management does play a very big role in the sustainability of that facility. And again, previous to 2014, 2015, the last ACFI drop away and the fiscal cliff we saw with the ACFI changes was that revenue phase for the industry is sort of closed out, and we're now in a cost management phase in terms of looking at our results and optimising the outcomes for the business. And then looking at that as we roll that up into the care result, the EBITDA for the facility, and then the EBITDA overall. As we said, there has been some decline from June 16 through to March 17 for the care result. Facility EBITDAs, really for the average, has also dropped away by $211, $325 from June 16. So when we are benchmarking though, it's worth noting that that facility EBITDA is really the benchmark that we would wish you to use. It's the best equivalence that we've got because it does go down to a facility level. The overall EBITDA, the line, the bottom box, is for the whole organisation. So when we're looking at that, we really need to make sure that we are, looking at apples and apples. So just to make sure that the information you're benchmarking against is equivalent for you. And really, when you look at the average facility EBITDA, that care and accommodation, we have the care result, the accommodation result, but it does exclude all investment and fundraising revenue, and is that true operational result that should be benchmarked, in relation to EBITDA. So just to be mindful of that as we move through and what you're looking at in these numbers. So just to wrap it up into a bit more of a visual outcome for the industry, in March 2016, the average care result was $10.43 per bed day, and the top 25% was $39.21. We moved through to March 17. That result has fallen away, as we know from those headwinds around ACFI and other challenges, to $9.93 per bed day and $38.29 for the top 25%. So there has been an easing in the result, and a lot of that can be sheeted home to two areas, one being obviously the ACFI changes, but also to some headwinds around growth in costs. And one of the things we did start to do in the the December 2016 report was to look at the share of care revenue between the government and the consumer. Obviously, one of the big changes for aged care reform has been the capacity of residents to pay more, or providers and residents to obtain more revenue from the consumer, has shown that although since 2008 the government share of revenue has actually increased to 75% in 2017, it's probably lower than they would have expected without that uptick in consumer payments. So moving forward, the government would hope that number to grow on the resident proportion from 24% upwards. And really, in terms of the provider outlook, we are hoping that you're able to generate more income and more revenue from that consumer side to make sure that we are covering our costs, as those costs continue to rise and revenue falls away from the Commonwealth. So important that we are looking at that, throughout the periods ahead. It's going to be important to understand that moving forward. So if we look at the care result, one of the things we do note is that in the peak really was in June and September of 2011, before the first changes to ACFI. So that was the first fiscal ACFI cliff that we saw, and that phase really ran through until June or so of 2013. The peaks you see on the right-hand side of that chart every September were up and until basically June and September of 2015, when the next lot of ACFI changes were sheeted home. So we started to see a decline again, and you can see that in September of 2016 there was no peak. that peak had been chopped off. The bulldozer had come in and removed the top of that particular mountain. So in terms of those ACFI reductions that started on July 1 and then moving through to the next changes on 1st of January of this year. So the changes to the scoring matrix and certainly the halving indexation in the CHC domain has started to have an impact. And we've seen that with a result of $9.93 in March. And really, although there had been that increasing surplus trend of 2013, you know, it's apparent that that lack of a September spike was the first part of that ACFI change and the initial impacts, and we'll be interested to see how that flows through to June of this year with the results, which we should have out to the market at the start of October with our roadshow. And just to show you where some of those headwinds are coming from, this is a comparison of the everyday living expenses compared to the basic daily fee. I think the basic daily fee currently stands at about $48. That's a green, you know, shaded in area at the rear. That the income you're receiving from the basic daily fee, which is about 85% of the single pension, and then the costs which comprise, you know, the everyday living expenses. So you've got the hotel services and utilities in the red, which currently stands at about $49 or so per day. Administration of $35, and then the sort of buff area below is a revenue gap between those two, which currently sits at about $31. So what we're seeing here is that the cost growth is far outstripping that revenue, and really in terms of where we sit, there's only one place for that gap in funding to come from, and that's from ACFI. So we're seeing that the care fee, the direct care revenue, as it were, from ACFI is now cross-subsidising everyday living expenses. So we do believe that there needs to be a discussion around how you might overcome that revenue gap, and whether that is floating the daily fee, having a base, of course, which would still probably be 85% of the single pension, but allowing providers to float that daily fee for consumers who do have capacity to pay to close the gap in that funding. Very important to note. But it is a good indicator of where some of those challenges and headwinds do exist within the industry around the gap between revenue and costs. And then to look at some of the expenses, you know, particularly as a percentage of care income, it's no shock to any of us that the predominant cost there is the care services, wages, etc., for care staff and so on. It sits around 50% across the board, so the bands all the way through there, you can see them articulated. The red line is the hotel services, which sit at about 17%, utilities, and then other services. One of the areas, of course, from the 1st of July, electricity prices went up quite significantly across the board and across the nation, as did gas. So some of those utilities providing in services like electricity, gas, etc., we'll need to keep an eye on that to see how that impacts on you know, costs, etc., moving forward. But there is some risks and some headwinds around those costs as we look forward. And then looking, as we said, location, size, demography, etc., does affect the facility level result. So when we're looking at it, we do also like to break out the data into the facility size, and normally we frame that by the number of beds per facility. So we had seen in the past, I guess the sweet spot, for want of a better term, has been facilities with a bed size of between 40 to 60, and that's still the case in March, you know, around $14 being the care result for those facilities. The next best was facilities around 60 to 80 places, and they're being ably challenged by larger premises with 80 to 100 places. This may be an indicator, I think, of our ability now to staff and run vertical builds better than we have in the past. We've had a history of building our facilities horizontally, and now a lot of activity built environment is being, you know, is vertical. So our ability to manage and optimize those locations is improving. That may be reflected perhaps in some of these figures. The thing to note, the under 40 places really have struggled. 2014, they were underwater, recovered a little bit by 2016, and declined again in March. And really it has to be said that, and we'll see that when we do the side-by-side comparison, that under 40 places is a bit of a struggle. Most are possibly historically hostels, etc., or regional rural locations, which again I think we know about 50% of them are in rural regional locations. So a difficult environment under 40 beds to get the economies of scale required. Not impossible, but is quite difficult. And then looking at the state-based results, as we said, the highest was New South Wales at around $14, almost $15. The two lowest performing states were WA, or WA is struggling. They've had some challenges over there. We did analyse the data to make sure that there wasn't any outliers that were skewing those effects. Some of it may be new entrants to the survey. It may be the case in the ACT, but certainly they are finding operating conditions more difficult certainly in WA and ACT for a number of reasons. But generally across the other states, there has been some improvement in their operations over the year to March. But as we said, if you look at the national average, it's still looking relatively relatively line ball. But that result of 993 is probably the front end of the ACFI changes and some other challenges out there in the market. But it does show that certainly aged care isn't a cookie cutter. And we are getting results that vary by location, state, demography, etc. Across the survey. And just to break out some of the care hours worked, we normally roll that up into a total care or total hours worked per resident per day across accommodation and care, but we do look at the individual areas. And as we would expect, care management is the bulk of the care hours that we're seeing in the industry or in the sector. Sorry. Yeah, and other care staff. In the blue, I think the enrolled and certified nurses, of course, therapy, which obviously with the changes to CHC and the ACFI may be difficult with allied health and others to optimise that, and registered nurses. So at the moment, we know a number of organisations are fully through their EBA process. But interesting to note that the care hours generally have been increasing across the sector, particularly for the last few years, as direct care improves. So moving then to the accommodation analytics, and just a bit of a brief analysis and side-by-side analysis as we move through. But just so you know how we do derive the accommodation result. Again, revenue on the revenue side, looking at the accommodation charges, daily payments, retentions from bonds if they still exist, the accommodation supplements and so on. And then on the expenses side, the property and maintenance, rental, depreciation, amortisation and interest. So just so how we derive that result in line with the care result as well. We did do a little bit of a review of the ACAR, which was released in 2017, and we saw that about 63% of the places that were placed went to private providers. So about 3,600 to NFPs and 6,000 odd to private providers. So it has been quite a strong trend in the last few ACARs around bed licences being released to private providers. And of course, probably interesting to note that a couple of re-entrants into the market who had exited the market and lease, etc., had received some beds within the ACAR release this time round. And then breaking that out into segments, we do see, as we said, about 63% were private providers, 14% charitable, 9% community-based, 13% religious, no state government, and there were a smattering that were deferred. So just a small number deferred, and that's the NA in the bottom there. And really, in terms of that result, as we said, 76,000 beds in 10 years, about 3,300 per year being built. We haven't seen any uptick really in beds at the moment from the last couple of ACARs, and hopefully we'll start to see that flow through to the market relatively soon. And really, as we said, looking at those movements in RADs and RACs, either currently held or taken during the year, has been some healthy growth there from March 16 on the bonds held, up from 247 up to 273, and then the deposits taken in the contemporary period, again quite strong growth, 285,000 in March, up to 312,000 average in March 17. So I think the strength of occupancy, the fact that it hasn't moved radically in the segment, means that providers have had the confidence to move that accommodation pricing upward in line with some of the real estate market changes that we saw in the first half of 2017. And in fact, we know that the current housing market growth phase, although it is expected to soften, we do expect, that softening, but the market did grow almost 30% in the 12 months to March 2017. So, national housing prices are still very strong, and as a result, you could expect that RADs, etc., could grow against that. And that average uplift of about $27,000 in the 12 months to March 17 is somewhat of an indicator of that. I guess if we look at the side-by-side analysis of facilities, interesting to note, the characteristics and then where they might lie in terms of the industry itself or the sector itself. Dementia wings, dementia, as we know, is almost now a standard operating requirement for any provider, whether it be in home or residential or other segments. And really, the average of about 60% of providers do have a dementia wing and ably representative there. I think, again, as we said, the multi-story, the vertical build is increasing, and we see about 44% of the market have a multi-story building. And we've seen a couple of plans for quite large-scale developments coming through around Australia, so that vertical build is occurring. I think in terms of those outcomes, really the most unsurprising result is that larger providers have facilities that are represented in both the top and the bottom quartiles of the survey, with about 92% of larger providers having a facility with a negative EBITDA, further underscoring that cross-subsidy that we spoke about earlier. And as I said, we want to have a bit more of a look at that in the June survey. And StewartBrown certainly is encouraging our clients and providers to routinely cost their mission, to ensure that their operations remain viable, to support that mission at the level desired. And really, as operating conditions tighten, we expect that those providers with a negative EBITDA really have to be contributing to either their mission or their strategic imperative in order to be maintained, because it is quite a drain on organisations. And really, 65% of providers have that negative EBITDA, but they also, at the same time, have a supported ratio higher than the 40%. And the bottom quartile is actually overrepresented that with a higher density of supported residents. 73% of those facilities having supported above 40%. And in a similar vein, perhaps the most surprising statistic that we saw, our gut feel anecdotally, we hear a lot of talk in the sector about where providers are struggling, and it's normally the rural remote cohort, our brothers in those sectors and sisters in those sectors that we hear are more likely to struggle. But 58% of facilities with a negative EBITDA were in a major city, which surprised us a little bit when we did do the side-by-side comparison. But half of the cohort, that bottom quartile of facilities, 48% were in rural locations. So certainly, I think rural providers, their conditions, operating conditions, are tougher. Certainly, with population drift to the cities and so on, and ageing in place, it is making it a little bit different out in the rural areas. And as we said, those providers who have facilities with less than 40 beds, they are double the representation in the bottom quartile as well. So showing that less than 40 places, it is a little bit harder to operate with those scales of efficiency. And as would be expected, really, it confirms that the majority of the top 25%, that top quartile, are located in major cities, with about 72% located in a major city. And then just looking to wrap it up in terms of hours worked per resident per day, looking at the accommodation hours worked, hotel services, of course, make up a bulk of that, with maintenance, which is important, administration, and then quality and education rounding that out. So just interesting to compare those and then roll them up as we do in the report for the total hours worked per client per day. And I think too, given the dependence that we do have on built environment in residential care, it is important that we observe the, having a realistic and robust depreciation expense. It's a non-cash expense, but a very important one, and something that we've been tracking certainly this year as a focus to look at what's required in order to maintain our facilities. And of course, the importance of depreciation is around two areas really. One is to make sure that the interior fit out is fit for purpose, and it's meeting both the requirements clinically, you know, and operationally for your service, but also to make sure that the amenity is suitable for the consumers. We know that that retail aspect of aged care, as it moves forward, the consumers will demand a different look and feel and a different amenity to what we may have had in the past, and being able to keep pace with that is quite important. The second part, of course, is that depreciation allows you to redevelop or rebuild your assets over time, and setting aside you know, appropriate amounts of money to allow that. So the two lines there at the bottom is the refurbishment charge that we expect that you may need to require, about $6.85. And then at the top is to actually replace the building. That's the pink sort of purpley line at the top at $27. So looking at how we're depreciating within the industry, we can see that we certainly are, as a bulk within the you know, the residential facility average, we're doing okay for refurbishment, probably not so well in terms of replacement. So there is some challenges there. But if we look at the listed providers, you can see that they're undershooting on all of those scores, quite low levels of depreciation. And if you look at the top table, you can see that for buildings, their replacement timelines are about 50 to 60 years, and then property improvements, you know, anywhere from 4 to 50 years, which in the current environment, I think for occupancy, you may struggle if you're not taking a contemporary approach to certainly property improvements around that consumer cohort. And it may affect occupancy into the future, and we'll be looking at some of the net present value issues for depreciation around what that might mean for consumers and their families moving forward. So I might just stop there before we move into home care to check and see if there are any questions. As I said, you're able to submit questions through the system, so please feel free to do that. So again, looking at the home care survey, and really just to give you a feel for what that looks like, again, about 19,000 packages for home care. So again, a very solid base for these insights and trends to be delivered to you. So just so you know that the size of the survey continues to grow, and moving into June, I think we're going to see it grow again. And then just to give you a feel for the bands, what we have tried to do on feedback from the industry and from the sector was to make sure that we do size our bands really to fit also too within the package level, so they're more equitable in terms of understanding where they sit within the packages. So package level 1 through to 4 in terms of provider income, etc., to make sure that they are equitable, make it a little bit easier for you to understand those numbers. And really, when we're looking at the paradigm around February 27 and the changes to the industry around that, there are 5 pretty important KPIs that we've identified moving forward. And to make sure that, you know, with those packages moving through, those metrics are there. And the first one is client care plan engagement time. And really from the first inquiry to when you have the client signed up and delivering services is an important window. You know, we know that there's been some issues, and we'll address that in just a little while, around the packages were released and obviously changes after February 27. But what we're seeing is that many providers are setting their first engagement with clients at around 24 hours. And if that client hasn't signed up after the initial inquiry, they're investigating why and trying to address that as quickly as possible. Then they're looking at if they haven't heard back, or the client hasn't picked up you know, the service within 3 to 4 days, is whether it's still economical to keep pursuing that client, or whether they need to refocus elsewhere. And really the other measure that we're looking at and is directly related to that engagement time is around conversion rate. So the percentage of inquiries that you're receiving which are then converted into clients. So important to consider those as you move forward. The second KPI really is around package retention. Of course, previous to you know, the changes around CDC, you were allocated packages as part of ACAR. Once ACAR was removed, we now have essentially the default market, which is clients having control of their packages and picking their own provider. So within that, the old package occupancy that we measured is no longer valid, really. And so we had to move to a different way of measuring that, and that's really around retention, the clients that you currently have and the packages you currently hold, and how many of them you retain from period to period, and then of course growth in the number of packages over time. So really looking at, you know, with there's no more package releases in terms of direct package release. The 14,000 packages that went out in March, you know, where have they gone? who's holding them and what growth are we seeing. And really it does point to, I guess, a change in approach as well in terms of staff need to be skilled up in sales techniques and approaches to ensure that they are meeting the needs of clients, addressing their concerns, etc. So you are retaining them and then growing your packages over time. The third KPI, again, is looking at revenue. We'll come into some more granular information around revenue and income utilisation. But important that you are providing the services that the client wants, of course, and then that is recognised as how much of their package they're actually using up. So we're seeing now, particularly on the My Aged Care website, a lot of questions around the percentage of the package available for direct care. So really, in terms of that, you want to make sure that you are providing as much care as possible to the client, of course, with reasonable amounts of admin and everything else and margin. But really, part of the trick there is to have that revenue utilisation, around 95%. That's the target that we would suggest, to make sure you are covering your fixed costs and other costs of taking on that client and providing their services. The other thing we have seen is there's a lot of talk around exit fees. There are also some providers charging entry fees in order to make sure that they have covered off on those startup costs around taking a client on, and that may be a commitment to time or other things to make sure the client is with them long enough to recoup those startup costs and those fixed overheads that they may have in providing the service, particularly in the startup phase. And really, the case managers, your case managers or your client managers out there on the ground should be responsible for making sure that those income utilisation targets are met, and really ensuring that the services providing are those that the client wants and happy to pay for. And the other one is our direct care costs, and really looking at that percentage to revenue as a KPI to make sure that your wages, your on-costs and travel are rolled up, and you can attribute those to your direct care. And again, those direct care costs, we're often seeing clients receiving queries from consumers around how much the package will be in direct care. So important you do know those amounts. And of course that doesn't include your admin and your margin. It's really just a direct cost of care. And we're recommending the levels around that sort of 50 to 55%. And it will vary, of course, on the packages that you hold, level 1 through level 4, and the numbers of each of those, to make sure that they are equitable, but certainly they're translatable across the packages. And then the fifth one, as I said, in the startup discussion around productivity, is quite fraught or can be fraught in healthcare, because there are a number of mitigating elements that we have within health, that can make it appear inequitable. But certainly within home care and residential care, we should be able to improve and judge our productivity as billable hours and so on. So really, client acuity and complexity is really, in essence, a proxy for staffing requirements. And we see that played out in the bands. Level 1 probably needs less clinical and other interventions as opposed to band 4. So that does impact on how you're actually staffing and running those packages. So really, you want to see that in case management and coordination as well, and make sure that your billable hours, etc., are reflecting the productivity of your staff. So looking at some of the more granular results and looking at EBIT as we move into the more granular results. So this is a survey average, and looking at the results across the board. Package level 1 has been difficult, and as I said, with that change to CHSP and pushing it out to 2020, it's unlikely that the bands, package level 1 will improve much in the interim. I think we did a quick calculation. We think there's about 141 packages out there at the moment, there or thereabouts. So it's not really a grouping that's going to be activated, for the industry moving forward. Then through bands 2, 3 and 4, obviously the results do improve in line with the size of the packages, and there has been some growth, certainly from 2016 to today, and that really has been due to two focuses really. One has been on that revenue utilisation, making sure that consumers are using their package appropriately and reasonably, and also to a focus on those costs, etc., related to operations. But in terms of the result, what's driving that, there were also some subsidy uplifts in the second half of 2016, which may have contributed a little bit to that. But again, I think a lot of it can be down to some of the improved revenue utilisation rates that we are seeing in the industry. And then looking at the results, if we roll that into the top quartile and against March 16, a little bit easier to see that visually than in those tables. We can see that March, that certainly through March, we saw an improvement, as I said, across most of the bands, but band 1 is still quite difficult. And really, just so you know, for the top quartile, the package numbers within that group is very, very low. So we don't recommend, band 1. The data's probably not sufficient to take too many trends out of. It's a bit volatile because of the low package numbers. But across the remaining bands, their performance is quite strong. And you can see that certainly, again, looking at the top quartile, quite a big differential there in the EBIT from $6.05 for the average in March 2017. The top quartile's result was $24.64. So again, the big differential there is really around the direct care and those costs, but also too that cost management issue arises again. Revenue utilisation as well, but certainly a focus on cost management and efficiency. In terms of client contact, are the clients receiving equitable levels of service and outcomes? Yes, they are. They can move now if they don't receive or think they're not receiving those. So the big difference there really is around those cost management items as well for the top quartile versus the remainder of the industry. And then again, talking about those revenue utilisation figures, they have improved quite dramatically. If you look at June 2016, 85% in band 2 up to 91%, 89 to 93 in band 3, and 85 to 95 in band 4. So quite strong focus on that revenue utilisation. I think that's also a combination perhaps of some repricing in the market, providers hopefully being more cognizant of their unit costs. We're very strong on providers understanding their unit costs and pricing appropriately. I think one of the challenges when you do have competition is often the first port of call is reduce prices or decrease margins. But the mantra should be better before cheaper in this respect, in making sure that you are maintaining your margins and looking at better efficiencies in operations, etc., before you do attack price. So very importantly, we do maintain that moving forward. And then for the top quartile, again, quite strong uplifts in that revenue utilisation for the top quartile, 86, almost 87% up to 91, 84 to 89, and 86 to 96 in band 4. So again, a strong focus on getting that revenue utilisation up, making sure the consumers are spending their package, but also to cost management being the other side of that equation, but strong revenue utilisation uptake. And then looking at those unspent funds, we were concerned throughout 2016, moving into the changes around portability, that providers may be left with large amounts of unspent funds within the packages. And of course, if a client decides to leave them or moves to residential care, that unspent fund would travel with them. So with that focus, there's still some unspent funds per client per package. You can see the numbers there within it, but and they're also all the funds across the periods. It's not just to March 2017, it's for as long as that package has been activated. So if you look at package level 4, it says that the average of all unspent funds is about $7,000. If you do the maths quickly against an average package amount of about $48,000, it is still more than 95%. But that is across all periods. It's not just this quarter. So over time, what we would expect is those figures will start to drop away if people maintain healthy revenue utilisation rates, and they should be more attributable to the package levels as time moves on, as those funds decline, as they're used up. And then just looking at the roll-up in terms of gross margin across the grouping, we could see that there was quite a good uplift in band 1. There was a negative margin of about 40% in that group. It's now down to 20%, so it's halved from June 2016. And still relatively low margins across the board, even the best being band 3 at 10.5, but still indicating that the operations, it's not a gold mine. It's a kind of difficult operating environment, And obviously with competition, as I said, there will be some pressure on margins. We had seen some margin erosion before, certainly February 2017. So making sure that you do focus on that issue of efficiency and productivity before you do attack pricing, because any changes to that will have quite significant results on your margin over time. So that better before cheaper should be the mantra moving forward. So what have we seen? We know certainly in February of this year and moving into March that Minister Wyatt released 14,000 packages, or the department released them in March 2017. And really there was a combination of clients that were already existing, having high-level packages assigned to them, and also to some movement of people that were in CHSP into packages as well. But there was 14,000 packages released. We also know at the same time about 76 new providers entered the home care market. So there is quite a strong uplift in new providers. Some of those were subcontractors that previously had been working with other organisations who themselves became an approved provider. But there were 76 new providers in the market at that time. So a lot of talk in the market about what happened to those 14,000 packages, why weren't they being activated, were they stuck within the My Aged Care system, and so on and so forth. But really when you look at it, some of the challenges around that were with consumers not understanding the process. I think we all know the complexity of aged care, and some of that is being passed through as packages not being activated. We did see a drop in referrals to existing providers, and that was a combination, I think, of the My Aged Care process along with competition, but also to consumers not activating or not understanding how they activate their packages as well. But there was some concern around referrals not coming through to existing providers, and that still is the case as far as we're aware. Of course, there was a natural attrition of packages as people pass or move into residential care, and not being replaced by allocated incoming transfers or referrals, as they may have been previously with ACAR. So that is also an area where we may have seen some slippage. And then of course, February 27, the advent of portability was that there was a movement of packages away from providers or to some providers. We've seen some strong results for providers who have worked very hard on their local area marketing and have pulled across consumers from other providers. So, that ability of consumers to exercise portability has seen some movement, and certainly some consumers were working themselves up to 2017, the February date, to move away from providers to others. And then, of course, as we said, existing clients may have had packages upgraded, or what we have seen too is some quite strong concierge processes from providers around assisting clients through the process to get them into a package, or to get an uplift in their package as well. The other thing that we noted, and I think we noted this in our December report, and moving through and looking at it again for our June report, was that there was a furious amount of advertising in sort of December and January around these changes, and education programs by a number of providers, looking at certainly the movement of consumers, but also to ensuring that once portability came, that they had a competitive location within the market. Lots of advertising, etc., going on. But some of the biggest uptakes that we've seen and talked to a number of providers have been around that local area promotion focus, and networking to attract those new consumers. So very much a competitive landscape at the moment. And of course CHSP as a pipeline, so where you have clients who you may identify as requiring some further assistance in home care, and again the provider acting as a concierge, as it were, to identify that client, so they're able to convert them to a package holder. So quite an interesting transition there from for providers to actually be in that area. And so we did want to just briefly show you what the occupancy of the packages previous to this, which we now can't use because of the changes, how we're going to look at retention and growth rates moving forward. So this data really isn't very illustrative of anything. It's just our March figures looking at the number of packages and how the movements may have occurred with the changes to portability. But really we'll be looking at the number of packages that you have at the start, so your opening amount across the bands, and then at the end of a period, the closing number, which will give us either a growth or a retraction number in terms of where you sit. That'll give us a net growth rate across the industry or the sector, and then obviously an average of what we're seeing in terms of retention rate. So really that's just a snapshot to show you what we'll be looking at moving forward around retention and growth, so you can get some feeling for how you're performing around maintaining it. And of course for us, looking at it, it's in the old retail parlance, it's easier to, and cheaper to keep a client than to seek a new client in most cases. So retention will be very important. Cover off your fixed costs, make sure that you are, you have a base level of operations, and then looking at retention once you're sure of your existing base. And again, looking at average staff hours, and this is across all packages, direct care of about 5 hours, 5.32 hours, 0.36 in agency staff, and then looking at case management and coordination, which I think has been an interesting challenge for many providers around case management. Of course, My Aged Care has put some new functionality around clients being able to do their own management, as it were, on the website and so on, and whether clients are valuing case management, particularly in packages level 1 and 2, and we've seen some challenging, behaviour around case management in those particular package levels. Administration support, and then the total staff hours of about 7 hours per client per week. So, looking at these numbers, case management particularly, we'll have a bit of a look at that in just a moment, but there has been some challenges around those numbers. And then across the bands, as you would expect, as a proxy for the acuity of the client, the complexity of their package, as we go through the bands, the hours obviously increase. And again, no surprises there, but it gives you an indicator of what the average total staff hours per client per week we are seeing across the 4 package levels. And then at the top quartile, again, as we're saying, slightly lower hours comparative to the rest of the market, but could be expressed in terms of efficiency and productivity and their ability to service the client, more quickly, as it were. But certainly, we'll be keeping an eye on these numbers moving forward. There are economies of scale, economies around some altered work practices such as notes, client notes and so on, being automated and so on and so forth. So use of technology and other areas to improve, client contact and total hours spent. And then, as I said, looking at case management and coordination costs as a percentage, pretty average across the bands, where it is, disseminated, but we are starting to see some variability or some elasticity, if you will, in case management and coordination and its application across the bands, particularly for bands 1 and 2. I think where we are seeing some self-management by clients. As I said, the new tool on the My Aged Care website, for good or for bad, is there to assist people, attempting to manage their own packages. So we may see in those lower value bands a drift away from case management and that going into the direct care percentages. But certainly across the board, as we can see, about 8% for the top quartile in terms of case management and coordination, and 10 to 12% in the rest of the market around that. So really, case management, you need to be able to sell it. Some consumers may not value it as a service, but something that, there's still a role to be played, of course, and articulating that to the consumer and the value of case management and coordination, I think will also be important for providers moving forward. And then just looking at administration costs, there was a lot of debate throughout 2016 around the admin costs. Do you break it out in your statements as a separate line item? Do you roll it up into your pricing, so on and so forth? Yeah, so these are the costs. I think the other issue too that we identified in the December report was around making sure you are recovering those admin costs as they were underfunded or unfunded in some cases. And as the costs, you can see, it's costing around 25% to manage the bands for the average, and then about 20% cost for the top quartile. So within that ballpark, you need to make sure that whatever you're doing, however you're pricing your services, that you are adequately recovering those admin costs. And again, admin will be flexible across the bands in terms of the complexity and acuity of the client, but admin doesn't change that much across the whole band, as we can see. So again, our concern was around providers not adequately recovering those administration costs through their pricing and services. And again, I think revenue utilisation assists with that, of course, as a fixed cost, but also to your pricing, as I said, to make sure you're not getting caught in a pricing trap around competition. And then really to look at some granular expenditure analysis. I won't dwell too long on these, we're almost out of time. But looking at the survey average, and then we'll drop to the top quartile to just give you a bit of a feel of the snapshot between each of the bands. Again, where we see information moving through. So band 1, again, difficult band to operate in, and the care costs are direct care and brokered at about 60%, case management at about 12%, and that admin's, given the size of the package, is probably overstated at 44%, but indicates again the difficulty in those bands. Band 2 slightly improves. Again, profit margin still pretty thin, but more normalised figures are around the other costs and expenses moving through, about 26% in admin. Band level 3 improves, and probably the better performing band, probably the most of the focus, I think, and probably the largest number of packages, I think, David, that was in the market, give or take package level 2. Again, showing similar numbers around, direct care and brokered services at around 53%, case management 11%, and then admin and support at about 24 to 25% of the total. And then band 4, again, similar figures across the thing. We may see some variability as we move out to June and then into the remainder of this year around, portability, changes in consumer needs and wants, but also to some other operating models with RV, seeing we have co-located staff, you don't have the travel time, all those sorts of things, how they may start to impact on the results of providers. And then across the survey average, so this is all the packages together across the whole survey, profit margin of about 8%. Overall, cost of direct care and brokered services around that 55%. Case management coming in at about 10%, and then admin at about 25%. So the rolled up numbers look pretty similar across the board. So then if we move to the top quartile, as we said, the main differential here is in that cost management particularly. And again, package level 1, as I said, is quite difficult for this cohort. The package levels, they've kind of exited band 1, I think, as a group, the top quartile, probably intentionally, I would think, because of the difficulty of managing it, but still their results are quite good comparatively to the average, particularly in the cost management. So if you look at case management and then admin, 7.9% and 21.2% for band 2. Again, very much a focus on maintaining or minimising costs in that area. Band 3, 25% gross profit margin, and then again, direct care and brokered services about 47%, and then again, declining costs around case management and admin. Band 4, similar again, really showing that they are maintaining that discipline across the bands regardless of the mix of packages they may have, but maintaining the discipline around that cost management. And then if you roll up the top quartile across all packages, looking at an average profit margin of about 21%, brokered services and direct costs at about 48%, case management at 8%, and then admin at around 22%. So not wildly different to the survey average, but certainly an improvement on those cost areas around case management, coordination, and also to admin. So what are the lessons learned? When we're looking at it in terms of where we're at as a market, and then taking consumer-directed care, portability, all the other challenges that we have, we've seen providers prepare quite early for changes. We're now getting better signalling, I think, from the government around what things are looking like. We've got things like the roadmap, which can give us pointers to where we're sitting within the market. So making sure that you are preparing early for any changes you see coming. Of course, we thought we had CHSP coming in 2018, that change. That's now been kicked out to 2020, so there is some time to prepare around those changes and make sure that your operations are scaled and appropriate for those changes which are coming through. And as I said, we've been quite strong as an organisation, talking to providers, talking to our clients around knowing, the items of service and what they're costing you, so you can adequately price them, size them, and also to be more flexible in your delivery. I think the granularity of pricing and the granularity of understanding your services and the inputs to it means that you can be more responsive to consumers because they're not going to be linear like they used to be in terms of packages. Here's a package, this is what you would get. It is going to be a little bit of a mix and match for consumers as they decide what services they want. And in order to maintain that revenue utilisation rate, you will need to be flexible in delivering those services and of course in their pricing and understanding what that price is composed of. So really you do need to be realistic in setting those prices. As we said, there was a little bit of slippage in margin leading up until February and the second half of last year. So making sure that you are keeping a focus on maintaining your margins, having that approach of better before cheaper and optimising your operations and setting a realistic price and recovering those admin costs as well. Being flexible and adaptable, I think it's easier to say, harder to do, but really once you do have a granular understanding of those service item components and how you're approaching the client and what their needs and wants are, then you can be more flexible because you have a really good understanding of what it takes to deliver that service and the outcome. And then of course, I think we're not well serviced by technology, particularly in aged care. I think we still have a way to go. A lot of segmentation of technology that we're seeing in, from residential to home, there's a lot of integration, etc. But certainly, use technology wherever possible to gain those efficiencies in service delivery. And of course, they will improve. There'll be new entrants and new products, etc., coming through to make sure that you are, taking full advantage of those. So when we look at the survey, changes that we do have in the pipeline around the survey and moving into June, and quite a few big changes coming up. We have been working through a change and an update of our interactive website, so more of that big data analysis, dashboards, reporting, but also allowing providers and staff to drill down more meaningfully into the data that they provide and then compare themselves to the sector and the cohort. So a lot of really good work undergoing in that website at the moment. Of course, we're able to provide more detailed accommodation and competitive pricing analysis for all facilities, something we do at the moment for clients, but certainly with RAD pricing, many people reviewing their pricing, we're able to provide quite granular analysis for providers. And of course, these sorts of updates, the sector updates, whether they be the quarterly ones, the two minors, September and March, or the two majors, June and December, we are able to do these updates and present these on request, whether in webinar or in person. So let us know if you do want your board, particularly if you're doing strategy. It's something that I have a number of presentations coming up, 2 boards around strategy, sizing the market, providing context before strategy meetings, and also just to give staff and other executives update around what the industry looks like, the trends that we're seeing. And normally following each of our survey periods, the 4 quarters, we often have a special report and newsletters that follow. So we had one on case management and coordination around staffing and the number of packages each staff member should be able to handle after our December report. We've done some special reports on ACFI and other things as well coming out of March. So keep an eye out for those, and if you do wish to receive those reports, you can let us know as well. So that brings us to the end. I think we're a little bit over time, and I don't think we've got any questions at the moment, which David hasn't been able to answer. So thank you. We will be recording this, and we have recorded the webinar for today. We'll clean it up and also to provide this presentation to you should you wish to share it within your organisation.